Thank you, Sophie, and good morning, ladies and gentlemen. What I want to cover in the next 20 minutes or so, leaving some time for questions at the end, is simply a look at the industry that we are all in, all part of, no matter what role we play in it, we're part of the global landscape. And I'm going to just walk you through kind of what happened over the last couple of years to lead us to this position we're currently in, which is a market boom period, there's shortages and growth markets there. Look at the outlook, why did it happen, bit of the forecast, what can be expected in the future, and just leave you with some of the key takeaways. Now, one of the problems with being in the forecasting business is you're faced with this raft of noise, changing situations and stuff. We're experiencing supply chain disruptions, shortages. Joe talked about the demise of Moore's Law, and I totally agree with him. It's just complete fallacy to say that Moore's Law is over. But people still talk about that. The pandemic recovery, the aftermath of that, the war in Ukraine and the repercussions from that, the economic sanctions, rising inflation, and now suddenly we're hearing all of these words that we never thought we'd be hearing again, things like inflation, recession. We haven't had to live with this since the not the dot-com crash, but the Lehman Brothers crash, 2007, 2008. So a lot of these items keep creeping up and we have to deal with them. And when you're trying to predict what's going to happen, you have to try to make sense of some of these noise on there. Now, I'm an engineer at heart. I don't look it, okay, I'm just in the business of marketing. I'm a marketeer also. But I treat this as an engineering problem. So when a piece of equipment doesn't work, you don't go into all the things that might happen. You check, is it plugged in? Have I switched it on? These are the first fundamental things you should start to check before you start going into all these highfalutin, nice intellectual problems of why it might not be working. You haven't switched the bloody thing on, okay? And that's what the problem is. So we try to look at this here in these kind of simplistic, very fundamental, common sense type of approach. We have been doing this for 33 years. I founded Future Horizon in 1989. So I keep pushing the Grim Reaper away because I say it's not due for me yet, okay? But we've been doing it a long time. We've learned a lot on the way. And before that, I spent 10 years with DataQuest. The thing that I've learned over that experience is keep looking at the hard data, the fundamentals. What can you measure? What can you touch? What can you actually look at? And the four things we look at is in essence the economy. How is the economy doing? The unit demand, what is the real demand from people that are buying stuff? The fab capacity, our ability to make that demand, and the average selling price, the price that we get for the parts that we design. So you can analyze that, and there is good data out there which can allow you to actually make some analysis of those trends. And then we kind of analyze that. And you've got to put that into perspective in terms of how do I feel about the data and what does that data mean to me? Because it means different things to different people. If I say to you, prices are going up, that's great news for the supplier, but really bad news for the customer. So again, the same data point means completely different things to different people. You have to try to look at that as well. There's a high degree of emotion. People get washed away with the hype. We can see that happening right now. So again, we unwind that and try to read through the fear, the uncertainty, the doubt, the hype, the enthusiasm, the emotion, and try to boil it down to an engineering issue. And we have been doing this for a while. When I started in the industry, state-of-the-art was a dual JK flip-flop, okay, and we couldn't get any bloody yield on that thing either, okay. So things haven't really changed in the last 55 odd years. They've just changed the number of transistors that are in there, but the problems are exactly the same. We do have a good track record. I'm not here to boast about it, but I will. This is some of the things that we really did get right, and we were the only analysts to forecast the upturn and the shortages. And right now, we're the only analyst to forecast the party's going to end. Okay, now the jury's out on that yet because the party hasn't ended yet. But I think, unfortunately, history will show that it is going to come to an end because all parties do. Okay, you get too drunk to drink anymore and you collapse. And then you have to wake up with a hangover the next morning. So what happened? How did we get to where we are? Well, this perfect storm broke actually in July of 2020. That was well before the COVID crisis really hit us in here. And we're talking here in terms of when you look at what happened in we had the COVID hitting in Q2. And then we had the sharp recovery in Q3 and a really big acceleration in Q4. And it was that momentum which set up the growth rate for 2021. And that's why we stuck our neck out back into 2020 to say it's going to be a double-digit growth year next year when everybody else was saying it wasn't. And the reason we said that was because of that momentum moving forward. You couldn't stop that momentum. It was by that time unstoppable. We were already experiencing strains on the supply chain. We were already experiencing overload and undercapacity, and once you get into that situation, it takes a long time to recover from it, typically 2 years before you can dig yourself out of that hole. So it was the 16th boom in the industry. People talk about it, oh, by surprise, this is a boom. We haven't seen this before. Yes, you have 16 times before if you stop to look back at what happened in there. And it wasn't even the strongest boom. People said, oh, this is the strongest boom we've ever experienced. It wasn't. It only hits number 11 in the top 16 hit parade, okay? There were many booms before that were much stronger, 40% growth, 37% growth. We were experiencing 26.6% growth. Hey, a big number. Yeah, a huge number, but it certainly wasn't the boom to end all booms. COVID was the trigger, what caused it to happen. It was going to happen anyway, but COVID was what pushed it over the fence. And so it wasn't really COVID that caused the shortage, it was COVID that allowed the shortage to actually gain traction. So the case really was, it was certainly security of supply was the problem. We'd lost track of actually securing the supply chain integrity. Right, the outlook. You look at the 4 things that I try to analyze here. The economy, that determines what users can afford to buy. And the stronger the economy, the more we can buy, the more our companies can buy, the more industry invests, the demand just simply is much stronger. So that's an important influencer. You cannot have a strong chip market in a weak economy. You can have a weak chip market in a strong economy if we kill ourselves, but it's very difficult to have a strong chip market in a weak economy. Unit demand reflects what we actually buy, but that's not what we need, okay? Because we buy what we need plus a bit or minus or plus. We buy to fill up the inventory. We buy because the lead time is extended. If the lead time goes from 6 weeks to 26 weeks, suddenly you've got to buy 20 weeks worth of product just to keep that supply chain going. So looking at the unit demand is not a proxy to what the real user demand actually is, because it has this inventory adjustment factor in there. Capacity determines what we can make, and that is a real reflection on units, because we make units. We don't make dollars, we make units. We make chips on a wafer. And if you have not enough wafer capacity, you cannot make the units. If you can't make the units, you get into a fundamental supply and demand equation, and prices will go. And it's very difficult to match supply and demand, because supply is on a 2-year window, plus the 4 to 6 months in wafer fab, okay? So you say you want more today. If you haven't ordered it, you've got to wait at least 4 months before you'll even get that part there while they put the wafers in the furnaces. And the average selling price is really what price you get for it, and that's determined by supply and demand, and also a little bit of value proposition in there as well. But frankly speaking, as you'll see, not much. What we try to do is to track where are we against the long-term trends for those 4 factors there. And if we're above the trend line, then only 2 things can be factual. One is the trend line has changed, or second point is you're going to go below the trend line to bring you back to the average. So you have to look at it from that point of view. There is no other explanation for why you are above the trend line. And trend lines don't change that often, by the way. This is where we are in the economy right now. A significant change since we were at the beginning of this year. We're now seeing inflation really grabbing the headlines. You can't pick up a newspaper today without inflation being there in the headlines somewhere. We've seen it in terms of petrol price increases, food increases, electricity increases, gas price increases, commodity price increases. These are all talking about really silly numbers. I mean, commodities going up by 80% from a year or 2 ago. Well, that feeds through into inflation. And we're now talking about inflation way above the 2% norm that the federal governments were kind of having as their target for several years now. And frankly speaking, found it hard to meet that big number. Now suddenly they're looking at 8%, 10% type of numbers there, which is really scary. We've had all sorts of stresses on the supply line which have contributed to these shortages, which have fed through to the supply chain and commodity price rises. And the trouble is that you can, and then we got people going back to work. So suddenly, where they had 2 years where they didn't have to spend money on their season tickets for their train rides or their petrol to get to work now, they kind of spent that money on other things. Now suddenly, they're having to spend money on being able to go back to work. And that's squeezing their disposable income, along with the fact that all of their commodity prices, electricity prices, petrol prices, etc., are also squeezing their disposable income. So we're suddenly finding that the consumer and businesses are now being squeezed in terms of how much extra money they have to spend on electronic equipment. We've got all this plus still the residing issue of what's going to happen in China with Taiwan. Will it be taken over? When will it be taken over? Will it be a bloody scenario? Will it be a friendly in inverted commas situation? We don't know. It's still there. But I guarantee you the Chinese are looking at what's happening in Ukraine to figure out what not to do when they decide to make a move there, because they're seeing how that plays out and how the West has reacted to that level of hostility. Unit demand. We are so far above the trend line now, it is scary. We are running, the trend line should be around 6.5 billion units per month. That's what the real trend line says demand ought to be. We're running 8.2 billion. Okay, that is 30% higher than what the real number is. Why? Because lead times are so long. Okay, but what happens the minute that supply and demand comes into balance, you liquidate that inventory. So suddenly you've got 26 weeks worth of inventory that you bought you don't need. So you immediately liquidate it. You don't buy anything for 6 months. Now you can argue, oh, I've got a long-term supply agreement in place. Yeah, they can't cancel on me. Okay, fine. You can ram it down your customers' throats and force him to take it. He won't like you for it. But at the end of the day, it just delays for 6 months when he won't buy anything from you. So it doesn't solve the problem. It doesn't rebuild that demand that really wasn't there. It's phantom demand. So what are you going to do? You end up with an order book that crashes. And when the order book crashes, semiconductor companies will do one thing, which we'll come to in a minute. So we're so far above that trend line, it has to go back down. Unless you can show to me where that is real demand. We really are buying 30% more product than we did over the last 30 years. And you can talk about cars and electrification and stuff like that. It's all drops in the ocean. There's not been a 30% increase in fundamental demand for electronic products. Shorter lead times will mean inventory liquidation, and that means unit shipments will drop like a rock. Capital spend. That little red circle line there is showing the increase in capital spend we've had, and it is huge. Now, this reflects front-end equipment capital spend, so there's a 1-year delay between you spending the money and then actually making wafers. Now, we spent that money. It's going to come on stream 3rd, 4th quarter of this year. Start to come on stream. Okay, so then suddenly you've got this increase in capacity. Again, it's about a 50% increase in incremental capacity to what we were spending just to keep the whole thing ticking over. Now that's aiming for that inflated unit target. Okay, so we're aiming to fulfill a phantom demand. So when the demand goes away, suddenly we got overcapacity, not just because we've overspent, but because we're aiming for too big a number. So that's one thing we have to really worry about, because once you spend that money, you've got to make it produce something for you. You can't just not use it. You've got a huge depreciation bill there ticking away, costing you a fortune, so you have to end up using that money there. And the average selling price here, nice vertical line there, the red line there going up and up and up. Prices have been going up for the last 18 months or so. Yep, that's good, but they come down just as fast. As you can see, I haven't drawn this chart out too far back in history, but the plummets are just as good, they're just the wrong way round, or the opposite way round. Again, they're hostage to Moore's law. It's interesting, but the average ASP growth is 0. So for all the work you guys do developing all these nice new advanced complex chips, someone else in your organization gives it away by reducing the price of existing chips that you're making. The average is 0. So, it's like running on a treadmill. You keep running fast just to stand still. But if you stop running fast, oh boy, are you in trouble there. Then you have to suffer an ASP decline. So you can't stop running, so you've got jobs for life, okay? No worries there, you've got jobs for life to keep that treadmill running. and that's what you've got to do. That's your role in life. You're the ones that produce the higher priced chips to offset the decline in the more mature chips. So, what is our forecast? I probably should put up a warning sign here with like, smoking can kill your health. Well, I'm afraid that the semiconductor industry can also be seriously damaging to your health and wealth as well. The first indicator is these two graphs here. They're statistical graphs, and what they do is they track the growth rate of the industry on a quarterly and annualized basis, looking at the same period 1 year previously. And the green line, the red line there, is when the quarterly number falls below that same quarterly number of 12 months previously, and the blue line there looks at it on a 12-month period and the 12 months previously there. When you track that back over the history of the industry, and we got data going back 45 years actually, so you do have a reasonably long period to look at there. When that blue line crosses the brown line there, that's always been a sign of entering into unstable, stormy waters ahead. And when the blue line crosses the brown line in front of it, that's a sign of good weather there. And you can see that the green circle there that I've circled there was the beginning of this current boom here. And yeah, once again, it was an accurate predictor of good times ahead. Unfortunately, the two lines crossed in the other way in March of this year. So we've had the first data point. One data point doesn't make a trend, okay? But I think that we're going to start to now see that data falling through. So it is an indicator that we are going to be moving into some stormy, choppy seas as we enter the end of this year, beginning of next year. Anecdotally, this is the third year of strong growth. Okay, and that doesn't happen very often. Okay, once you get 3 years behind you, the fourth year starts to look a bit rocky anecdotally as well. And we're now heading into this situation with capex booming and the economy starting to go into signs of recession type situation. So we've got a bit of a double whammy building up in there, that just as we're building up all this capacity, the market's falling apart, and that's two kind of horrible blows for the industry to have to deal with. So again, the chances are that it's going to have a fairly negative effect. We did this analysis of the cycle after the .com double boom burst because we wanted to see what really happened. And what you find is you get this nice, long, slow build-up of market boom, and then when the whole supply and demand situation comes into balance, it plummets like a rock, takes about a year to reach the bottom, and then you start the long, slow climb up. So you've got a year down and about 3 or 4 years moving back up the curve there. But it has been an incredibly strong predictor. And it's really based on the fact that as demand rises, lead time extend, buyers order more stock to cover the delay and the just-in-case type of situations. Lead time extends more as suppliers struggle to meet that increased level of demand. It's just a natural positive cycle. Once the capacity maxes out, then you need additional capacity. That takes 1 to 2 years minimum to putting that capacity online. But you're targeting an overheated stimulus of demand. Had been a .com, it was twice what the real demand was. Right now, be thankful, it's only 30% what the real demand is. So it's not going to be quite as bad as the .com bust. When supply overshoots the demand, then you get this radical readjustment there, the liquidation, and that can go down to about 0.5, and it looks like it might even go, actually this time, a little bit worse. But that means it might recover a little bit faster. There are no soft landings, so we're right now, right at the top of the roller coaster, peering over the edge, and we're not quite sure when they're going to release the brakes to send us hurtling down the white knuckle ride that we can expect as we start to move down. So our forecast for this year, we revised our forecast at the beginning of this week, and we've reduced it from a 10% growth for this year to about a 6% growth. So still a good number. But it's not really indicative of what will happen in the future. 10% is still possible, depending on timing. So our most optimistic number still keeps us on the 10%, but it could go down to 4% if things kind of turn sour a little bit quicker than we want. So we're really down to a timing issue here. I think it's inevitable that we're going to see this correction. The issue now is when exactly will it kick in? And that I can't tell you. That's just something which is you're just going to keep your eyes open, keep your ears to the ground, and be prepared for it to come, because you can't delay. Because when the bubble does burst, it bursts, okay? It doesn't go down nice and slowly. It will collapse. It will burst very, very dramatically. The forecast for next year, really horrible, negative 22%, okay? And that's just maths, okay? It's just simply the maths of rolling through that growth rate, rolling through that momentum. You are bound to see some kind of a correction there as we move down that negative slope and start to bottom out at the other end of the side. Don't be surprised, because this is the 17th recession we will be having. Okay, we've seen this 16 times before, so we should be well equipped to deal with it. We're all battle scarred, we've all been through it before, we all know exactly what to do, except nobody wants to know about it. They're all denial that it's going to happen. So you pick up the newspaper, and in the same way as you see recession, inflation problems, you see there, oh, I'm going to put up prices next year by 6 to 9% because, I'm sold out and blah, 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 and blah, blah, blah. And someone else says, oh, there's going to be shortages through 2023. Oh, in your dreams, my friend, okay? Those things won't happen. Okay, but you're still seeing this hype out there telling us that everything, the garden, the party is going to go on forever and forever. So the fuse has already been lit, I'm afraid, and it's now just a question of timing as to when it happens. So some of the key takeaways. It's different this time. Okay, how many times have I heard that in my lifetime? It's different this time. Those are the 4 most dangerous words in the English language. Okay, it never really is different this time. But it reminded me of this, not that I was there when she said it, but this Polish philosopher came out with this statement which said that before a revolution happens, it's perceived as impossible. After it's happened, it's seen as having been inevitable. Well, all I would suggest is you simply replace the word revolution for semiconductor recession, chip market collapse. Because right now everybody says it's impossible, it's never going to happen. I guarantee you this time next year, say, well, we saw that coming, yeah, it was going to happen. Of course it was, it's cyclical and blah, blah, blah. So I think it is inevitable. And that's why I spend an awful lot of time looking at history. Not history about when did someone go to a war and this big battle of this, that and the other, but the mistakes, the history of the industry. It gives us the tools to analyze and explain the problems of the past. And if you can analyze the problems in the past, hopefully you can avoid making those same mistakes in the future. It shows us patterns which might otherwise be invisible when you're blinded by the present, the booms and the stuff that we're going through now. It helps you stand back and look at some of those issues and patterns to see how would those patterns reflect if they were repeated in today's environment. And it provides a crucial perspective for understanding the current and the future outlook. So that's why I always pay a lot of attention on looking at the historical trends in the industry, because those trends you can pretty much rely on, or you ought to be able to find a reason why they no longer apply. And unless you can find a reason, a genuine reason why they no longer apply, I think it's a pretty safe bet for you to assume that actually they still will be applying, and I better be careful about it. So it helps you keep track of the real fundamentals and avoid the froth and the noise and the hype that we're exposed to on a regular basis. So thank you very much. I hope I didn't bring too bad news, because the good news is after the bad news comes the good news. There'll be another market boom in 2024, starting then. So we just got to dig in and weather the storm, because the storm is going to come. And those that react fast to that and definitively to that will actually survive it a lot better than ones that procrastinate and delay to do what has to be done. Thank you.